Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Anything said in this piece, opinion only. Let's kick off. Markets absolutely fell off a cliff. Yesterday, all equity markets were down. The Dow, the S&P, the Nasdaq was down. European markets were down. The UK was down. Jerome Powell has frightened financial markets. He stated clearly that the Fed is going to get more hawkish and going to raise rates faster than anticipated and faster than predicted. And I've been saying over and over again on this channel, rates are going to rise in the US. We are talking that by June 2023, rates in the States will be, that's Fed rates, will be 6%, 6.5%, inflation running at 8 to 8.5% in the US. That's my opinion. That's what I think. Mortgage rates have gone up again. They're the highest since November 2022. In the US, the 30-year mortgage now running at 6.93, just below the 7.08 two-decade high that was already quoted in 2022. Also in the UK, rates are going to go up. Mortgage rates are going to go up. Property is the next area, the next asset class to crash. You're going to see a 25-30% drop in property prices in the UK and in the US. I know everyone says it's never going to happen. It's not going to happen. There's all these secure areas, never impact on London, never impact on New York. It's going to happen. Mark my words, it's going to happen. Going on to equity markets, again, following on from the Jerome Powell State of the Economy testimony to Congress over Tuesday and Wednesday, markets have been frightened and it's clearly stated that rates are going to go up. It's very hawkish, and members of the Feds have clearly quoted that they are more likely to raise rates than stop raising rates. Okay? By how much? Anyone's guess. But at the moment we're looking at a 25 basis point rise at the March FOMC meeting in the US. Now, that could rise to 50 basis points if the non-farm payrolls come in higher than expected. If they come in higher than expected, which is good for the economy. In other words, the economy is growing, bad for inflation, bad for interest rates, okay? Bad for recession. Why? Because as the economy fills with full employment, they're going to have the cost of those companies increasing wage inflation. The next driver in inflation is wage inflation, not necessarily commodity prices. You've now got wheat at the lowest since summer of 2021. So therefore the price of bread should be going down. It's not, because the wholesalers and the retailers and the manufacturers are exploiting that drop in commodity prices by adding it on to the retail price. So inflation is going to stay the same. It's not going to drop down to the 2% level. This is where we're at. Prices are going to stay the same or rise further, not going to drop to 2%. And if any central bank thinks that we can get rates down to 2%, they are seriously mistaken. Not going to happen. If you look at foreign exchange markets, strong dollar out there against the pound, the euro, and the yen, and the Canadian dollar, and the Aussie dollar. Why? Expecting rates to go up. The US 10-year Treasury running at 3.92%. Look at the crypto sector. Remember, we've been saying over and over again, when it comes to cryptos, when it comes to cryptocurrencies, they are susceptible to high interest rates. They're a high-risk asset. Not only that, Silvergate Bank, crypto bank, has gone effectively liquidating. Okay? Those people who have money with it, they'll get their money back, but it's liquidating its operation. It's gone effectively bust, and that's had a massive impact on the crypto sector, in addition to high interest rates. So Bitcoin dropped overnight just to below 20,000, dropped $1,600 yesterday, or $1,900 in one day. It's now below 20,000. Next stop is going to be 15,000, and it's going to continue falling as rates rise and more scandals enter the market. There's going to be more bankruptcies, more platforms going busts, more exchanges that have difficulties. There's going to be less liquidity around, and that's going to put huge pressure on those investors and those traders who are trading the crypto sector. Anyone who's holding cryptos of large hedge funds are now suffering significant losses as a result of the drop in Bitcoin. Moving on to shares, Tesla. I stated clearly that Tesla is going to fall to $140 a share purely on technicals, nothing to do with fundamentals with the company. So at the moment it's far too high. It was far too high. It's now 167, heading towards the 140 level. Following on, Meta's also going to fall to 140, as you're going to have falls in Amazon, Apple, Google, CRM, Salesforce, etc., etc. The banking sector specifically lost a hell of a lot yesterday with the JP Morgans and the Goldman Sachs, but also some of the smaller banks lost. SVB Financial was down huge amounts after they're now going for a cash call because they're in financial trouble. So again, the banks are going to end up suffering as rates rise, where normally they should make money, but as more and more companies will go into trouble, that's going to increase the credit or the debt problem with the banks. They're going to have higher defaults, and that could impact on the profitability of the banks. Meanwhile, Joe Biden wants to introduce some sort of 6.4 trillion budget or whatever the case may be. I don't think that's going to be approved by Congress or the Senate. It's probably going to be not going to be. The Republicans want specifics on how they're going to increase taxes, because Republicans are against increased taxing and Democrats are in favor of it. That'll have also an impact. We're going to recession in 2023. That's absolutely, I would say, well, I can't say for certain, because if you've got full employment, that is a counter to a recession, but my really strong opinion is that unemployment will rise, and once that does rise, we're going to go into a significant recession. This is Meir Volensky with Driving Markets. You can subscribe, share, comment. You can also see me on TikTok and on Instagram. Have a good day.